China's export-led economy is struggling. Shipments are stalled. A potential shift looms as Beijing considers trade talks. But China is on the brink of a major economic crisis. U.S. President Trump's 145% tariffs, coupled with China's deflation, are causing a downward spiral. Chinese factories, losing billions in export markets overnight due to order cancellations from American companies, risk collapse, potentially affecting over 15 million workers. Beijing faces a workforce crisis, with bankruptcies mounting in once bustling facilities. Workers and small factory owners bear the brunt. China's economic data now contradicts the long-held myth of continuous growth. Falling consumer and producer price indices signal deflation, indicating stalled production and declining spending, forcing companies to sell below cost. The real estate market collapse mirrors aspects of the 2008 crisis. Despite nationalist rhetoric urging resilience, rising unemployment erodes its impact. While some suggest a shift to domestic consumption, exports remain crucial for foreign currency, and Trump's tariffs are crippling. China labels Trump's tariffs arbitrary, while the U.S. cites intellectual property theft, market closure, and currency manipulation demanding fair trade. The new tariffs immediately hurt China's exports as U.S. buyers canceled orders, unwilling to pay the extra 145%. This devastated Chinese factories with thin profit margins and reliance on post-delivery payments. Order cancellations led to piled-up inventory and bank pressures, resulting in bankruptcies and closures. Consider a business owner needing a significant advance payment to even export, then facing bank loans potentially exceeding their investment, leaving little profit even before tariffs. Now, with U.S. tariffs, Chinese factories near bankruptcy. Empty cargo ships and a shaken maritime trade balance are logical outcomes. The once thriving China-US shipping route sees container occupancy rates plummeting from 90% to 50 to 60%, with freight rates drastically falling, creating a crisis for shipping companies. The U.S. aims to weaken China's global market dominance with tariffs. As American companies seek production in Vietnam, India, or Mexico, millions in expected Chinese orders are cut. Higher customs barriers mean American consumers aren't buying pricier Chinese goods, and overall demand is falling. Adding giants like Boeing illustrates this. In retaliation, Beijing restricts Boeing purchases and postpones deliveries, a move that could backfire given the hundreds of Boeing aircraft currently in China needing Boeing support for safe operation. Even Xi Jinping's official plane is a Boeing 747. Boycotting Boeing risks flight safety, potentially pushing Chinese airlines to Airbus, a logistically and financially complex shift. Analysts believe Beijing might show flexibility, as the economy needs aircraft. Xi's stance might seem like China can absorb the cost due to its market size, but it's self-damaging. On the ground, Chinese factory owners face the worst. The U.S. market's closure due to tariffs leaves them with billions in unsold stock. Shifting to other markets offers partial relief, but the global market isn't limitless, with Europe slowing and Asian markets smaller than the U.S. The post-COVID recovery didn't meet China's hopes. Order cancellations leave factories owing banks and workers with no cash for wages. Mass bankruptcies are emerging, turning the Chinese dream into a nightmare for producers accustomed to growth. Online videos show worker complaints of closures and unpaid wages. The CCP leadership's biggest fear might be mass protests by unemployed youth in major cities, with reports of even graduates struggling to find jobs. How will Beijing address this? While official statements tout growth in Africa and the Middle East, economists doubt these can replace the U.S. market's volume. The $600 billion China-U.S. trade could fall to $400 billion by end 2025, a major blow to GDP and employment. Western companies' China Plus One strategy exacerbates this, reducing investment and employment while youth unemployment rises. Beyond exports, China faces domestic issues: a burst real estate bubble, stagnant construction, risky bank loans, and strained public finances. Most worrying is youth unemployment. Beijing, once promising a bright future, now can't provide jobs for millions of graduates. Young people are organizing silent protests online, criticizing the administration. While censorship exists, economic realities can't be hidden. Xi might blame foreign powers, but street sentiment is uneasy. This raises questions about China's global power status. Most experts see short-term stability but significant medium-term risk. If the US trade war persists, China might lack alternatives. Domestic demand isn't enough. Real estate and financial market bankruptcies could trigger social unrest. Beijing pursues new trade deals in East Asia and the Middle East, but the lost volume is huge. The economic miracle faces turbulence. Empty ports and low freight rates are visible signs. Shipping companies report canceled voyages and half-empty ships. Containers once scarce now rot in warehouses. This shakes logistics and China's production as factories can't ship and lay off workers. Even the hopeful spring season passed quietly due to low demand. Some compare this to a major political test. Economic slowdown and unemployment could increase protests. Xi's response, repression, or reform is critical. Current signs point to an authoritarian line, while the US pushes for reform and competition, limiting Beijing's options. The inability to appease youth anger is a major concern. Without change, China's development story could falter. Gloom reflects real problems, from unfinished buildings to bad debts. However, growing distrust of information about China exists, with beliefs of government data manipulation and suppressed truths. This void feeds itself, increasing with economic fragility. By backtracking on information liberalization, China risks hindering its economic restructuring. The country might become an example of authoritarian inefficiency, like the Soviet Union's information control leading to repression and economic lies. China's partial opening aimed to avoid this, allowing technical knowledge flow. Now, a culture of fear prioritizes national security over the economy, limiting information flow. Monetary policy and bank reports echo Xi Jinping thought. Foreign consultants are viewed suspiciously. This hinders complex decision-making needed for China's sophisticated economy. Individual freedom retreats. While some Chinese hold liberal views privately, the information vacuum poses a greater threat. Diminished price signals complicate capital allocation, crucial as a shrinking workforce requires productivity increases. If investments in EVs and semiconductors are based on flawed data, the transition is unlikely to succeed. While admirers claim key decision-makers have good information, what data Xi sees is unknown. As the public sphere shrinks, private information flows likely become more distorted and less scrutinized. No one wants to report policy failures. Liberal thinkers understood that free information improves decision-making and societal development. Suppressed information becomes a source of power and corruption, increasing distortions. China has opportunities and challenges. Is it heading towards stagnation, or will it find a way out? Are US tariffs forcing Beijing to concede, or will resistance continue? What will long-term youth unemployment lead to? Protests within China might grow louder. Beijing might seek compromises. This uncertainty also reshapes global supply chains. Whether China remains the world's factory, how US trade evolves, and the future outlook for young people are key questions. What do you think? Is the tariff weapon shaking China? Will Xi reform or take a harder line? What could youth unemployment lead to? Share your thoughts, subscribe, and like the video. Our next video will cover similar global economic crises and maneuvers. Thank you for watching.